Thanks for joining us, everyone. Welcome to the latest edition of News of the Money World. I'm Darcy. This is Rupert. How are you, Rupert?
Very well. How are you this afternoon?
Good, pretty good. I'm anxious to kind of get on with this conversation because there's a few interesting things that mind has kind of been cogitating on lately, specifically with the U-turns that we've seen finally of the U.S. Federal Reserve. They had their annual conference, you could say, in Jackson Hole, Wyoming. So Powell, or J Pow, as his friends call him, got a little bit of a kapow from the J hole. That's how we talk, right? In the money space.
Exactly.
But kind of signals an end to the battle, right? Like an accomplished type thing. I found like a lot of the rhetoric, a lot of the words that he was using in his speech was either really humble, which kind of felt a little bit unusual, or a little bit contradictory. It was almost like what he was saying and doing previously kind of didn't matter anymore. But even making comments like the good ship transitory was a crowded one, I thought was kind of like, that's interesting. Are you admitting that that wasn't actually true? So what's your take though on that speech? Because it was different from the other speeches, wasn't it?
Yeah, it was an uncharacteristically open speech, and kind of, I think, letting down the guard slightly and saying things like, hey, look, we admit we got transitory wrong, but that was what the data was telling us. That's where everyone else was. And so there wasn't anything we could have done differently. So on one hand, I think it's pretty clear, and it's pretty hard to argue any other way. There's a lot of opening the door to the mistakes, but also being very clear about the fact that they see their job as reacting to data, and they will react to what the data says. And I think you kind of also, that's the not so humble pie piece of going, well, what did you expect us to do when we saw that data? And that's why we've seen that kind of the moves over the last little wee while, where on one hand, you can argue pretty strongly the data shows, and kind of a lot of the anecdotal evidence shows, that the economy in the US is slowing pretty sharply. Yet at the same time, they're waiting for the data. They're waiting for the data to show that inflation has come down, finally accepted that it has come far enough and that they are where they need to be. But at the same time, it's quite interesting, right? And yeah, probably almost pushing or head on into one of the biggest kind of criticisms of this current Fed. They are simply reacting to short-term data pieces. And that's clearly, I think there's almost an acknowledgement of going, yep, that's what we're doing, and that's what we're going to keep doing.
About these time lags then, as this is just a natural function of centralized authority trying to have monetary policy roll out and back to the data. The data is always going to be behind. It's always going to be trying to adjust your course by looking in the rear view mirror. But is that kind of like an unrealistic use pull out that, hey, we're just reacting to the data? Because that always gives them an excuse to create policy errors and say, hey, we're just reacting to the data.
It's a really hard one, right? Because the problem with a central bank, right, at the end of the day, its job is to create financial outcomes, and its only real tool is to use information that sits around it, and it's only got one very blunt instrument, which is interest rates. I think the bit that I've been doing a bit of reading on over the weekend is this kind of the fact that it took 18 months to 2 years for higher interest rates to really bite. Is that a function of the lags and kind of a new way of looking at the economy? Or is it actually a function of we've come off the back of this kind of weird COVID period, plus record high immigration, plus record high government spending? So, and I think that's kind of, we've talked about this a little bit before as well, right? I think there's so much going on in this economy. And I would also very strongly argue that Jerome Powell has been fighting this inflation battle with probably 1.5 hands tied behind his back because of what's been happening on government spending and immigration at the same time.
Yeah, and I guess that is this return from initially what would have been or was fiscal dominance now more to monetary dominance. Kind of like the right hand slapping you around sometimes it's the left hand. But either way, you're just getting punished. Either the government is taking a lot of tax out of the system and they're trying to inject it their way, or the monetary authority is taking money out of your back pocket or making it cheaper to borrow money. But either way, there are these controllers behind the scenes, right? And we're seeing the same thing play out here in New Zealand. What is your general vibe though? Like, do you think kind of like a car, push the brake pedal so many times, right? And then it comes to an end. It comes to a stop. kind of feel like just at the very beginning phases here, just tapping on that brake pedal if they do indeed go ahead with just one cut? Do you think that they'll be forced into a situation where the cliff is approaching and they're just slamming on the brakes right away? What do you think they're going to do?
A really hard one, right? Because so I think it's a little bit the analogy that kind of someone talked to me about was 2007. So 2007, that was kind of a rate cut cycle when that kind of started, and that was off the back of arguably where interest rates had been pushed pretty high to kind of control the economy and control inflation. And I think that one there, right, where they went through two or three small cuts before they went for the GFC hit, and then of course they went to zero and they went hard. And that's the big bit that we don't really know. They'll be keeping their powder very dry for this at the moment of saying, look, how hard do we need to go? It will all depend on where and how the economy falls off a cliff. The other point that was raised over the weekend was actually doesn't have a huge amount of room to move right now, because the problem you've got is with the proximity to the election. So if he does 25 points, okay, everyone acknowledges that's a bit of a nothing move. That's enough to kind of send a strong signal, not really enough to kind of change too much sentiment or change too much, but probably does enough to kind of make people happy. If he goes into a 50 points or 75 points, even 50 points, no one's talking about 75. But if he goes to 50 and then follows it up with it, and we might do the same again shortly, I think all of a sudden he runs this massive risk of political interference ahead of that November 5th election. And so, again, coming back to this is why, I mean, it's a bitch of a job, right? He's kind of trying to he's not allowed to just come out and tell the truth around this is what the best outcome is going to be. He's actually got to kind of try and figure out what the best political outcome has got to be as much as that. Because the other thing we can't forget about, right? We've got Donald Trump coming out talking about growing the deficit. Kamala Harris, well, she hasn't said anything at all, but I'm assuming she'll probably look to grow the deficit as well. And so you've also got this whole, hold on a sec, how much do you pull back now in the anticipation that you've got a kind of a new administration that is actually going to be off buying a whole lot of votes next year, which is kind of the new way of operating in politics. And that means a whole lot more spending.
Fun times. Over here in New Zealand, we've already seen our first official cash rate reduction. I'm still kind of about that, just going, that was the right move. That was the right time. I didn't see it coming for sure. I definitely think that you were saying before around what they have to say and what they actually do are often very different things. Unapologetically, they will just say, no, I didn't mean that. And they just don't care. And so whether it's a U-turn or otherwise, whether it's a reversal, they were always planning on doing it. They always leave the door open kind of to be justified, right, in their own eyes.
Yeah, but look, I'm in two minds on the New Zealand one. Was it a U-turn? Yes. Was it a data-driven U-turn? Also yes. I think talking to a lot of businesses and a lot of people around the place at the moment, what is increasingly clear is that the central banks, is that the New Zealand economy has really slowed markedly over the last 2 to 3 months. And that was why they did what they did, right? They didn't anticipate that happening. And yeah, they got that forecast wrong. But let's be honest, everyone gets it wrong. And I think probably the big mistake that we make is we're giving expect central banks to be right, whereas we know economists are normally wrong. So it's kind of the sad truth, right? Like over the last 4 years, anyone that's tried to predict markets has got it wrong. Anyone that's tried to predict economics has got it wrong.
Yeah.
The big issue with central banks is that when they get it wrong, it's a massive impact on everyone's lives. And it's just a sad reality, right? I don't think there's a fix for that.
You can at least apologize, though, right, Rupert?
Whoa, no, Darcy. You've worked in the finance industry for long enough to know that we do not apologise.
I'm just wondering who their disputes resolution scheme is, the old RBN. But connected, I guess, a little bit. Well, not connected a little bit. I think it's a massive influence. New Zealand share market has seen quite a significant uptick, probably since July, right? And I think it's something like last 12 months from right now, it's something like 9.45% return. A lot of that, though, was in the last, I guess, 6 weeks or so.
Yeah, 6-8 weeks, yeah.
And so, correct me if I'm wrong, but I'm just thinking, hey, interest rates are falling, therefore it's going to rotate out of income more into growth assets. New Zealand's a bit unique the things that I've kind of been thinking about is just how uncorrelated New Zealand is to the rest of the world. And I wonder if markets who have been probably unreasonably punished by high interest rates, I know that's a strong way of saying it,
Yeah.
but markets that have been really under the heavy hand of the central bank, they have a bigger gasp of air to take when they get set free. And I wonder if foreign capital is finding a way into our New Zealand share market because of the fact that the rebound you might be felt more severely here. I don't know. Like there's other reasons why the market has kind of bounded. So why don't you give us the mainstream views first before I kind of butcher it with an alternative theory there?
Yeah, but you've said it all right. It's interest rate driven. I mean, our market is it's a market which is largely retail focused, which is dividend focused, and all of a sudden those dividends are worth a whole lot more, right? You can't go and buy the 5 year paper at 5.5, 6% anymore. So you know what? A spark dividend at kind of 6, 7% yield looks increasingly attractive. And so whether it be a group of utilities and infrastructure plays, so the infra tools, the Sparks, the Chorus, the energy companies, straight dividend play, and that those dividends are now worth a whole lot more. Let's
Yeah.
also not forget about the record profits that the energy companies are about to print, which is also helpful. Energy crisis is great for the New Zealand stock market. Second part of the story is property, right? And property has been well and truly beaten up here. I think interestingly, yeah, we've talked a little bit about the movement in cap rates and how what that should have done to kind of commercial property valuations, but it hasn't necessarily been there. The stock market has put that value on the commercial property companies. It's why they're all trading at a discount to book. But all of a sudden, with interest rates coming down, those cap rates start to move. Again, the retirement sector, residential property. I think what we're really starting to see is people are starting to see through this medium to short term and go, hold on a sec, I'm starting to see some real value here because I've got whole swathes of the stock market which are trading at discount to book value. And that just cannot last, right? And
Mm.
so now the interest rates are moving back into line, and that's what we're starting to see reverse as well. It is pretty outstanding, though, right? When you go, international markets have grown at, I think over the last 3 years, they're at about 12% per annum. New Zealand's been at zero. So we've got a lot of catching up to do just to kind of make up the gains that we haven't earned versus every other market in the world.
And kind of what you were saying before, it was connected to this, right? Like it is a complex system when we're trying to understand the economy or a market or even a business. Multiple things can influence it, not just one. And there can be often different feedbacks going on. Things can resonate and blow things out of proportion. So the New Zealand share market, though, is something that I think a lot of New Zealand investors, when they're investing, probably don't think too much, unless they are individual share investors and they want to have that exposure direct. Kind of like what I bother when we can just into some tech stocks in the U.S. I wonder if we correct me if I'm wrong here, but would you kind of put, say, New Zealand in the same sort of bucket, apart from the tax advantages of investing in New Zealand, put them in the same sort of bucket as somewhere in between, say, U.S. markets or rest of world? Like, how does it fit from a risk profile for you?
I guess my concern with I think it's much higher risk, to be honest with you. I think the New Zealand market is a much higher risk market than others for two very simple reasons. One is we have an economy, sorry, two reasons. One is that listed businesses are largely domestic focused, right? The only kind of large listed business that's international is probably Fishbuckle Healthcare. There are a few others, but there's not a huge amount there, right? A2 Milk. But again, it's a domestically focused economy, a domestically focused market. Problem number two is then you go, actually, we know the New Zealand market, it's small, it can be exposed to wild shocks, natural risks. There's a lot of riskiness associated with that. And so, yeah, that's why, to my mind, I actually see the New Zealand market as being a high risk market. The third problem we have in the New Zealand is that it's sentiment driven. It's much more retail focused than any other global market, and unfortunately, retail is driven by sentiment. And yeah, so kind of to my mind, I unashamedly, I'm not a big fan of the New Zealand market. I think it's small. I think it's higher risk than others, and doesn't necessarily offer that growth opportunity that others do as well, right? I mean, you just think about where we're going right now. We've got, I think it's probably 15 to 20% of the New Zealand Stock Exchange is covered up by kind of the gentailers, right? Those four New Zealand energy companies who 4 or 5 who are about to be told by the government that they have to accelerate their plans on investing in energy to push down energy prices, which is going to mean no more dividend and lower long-term earnings. And you kind of go, the right answer for New Zealand, so the government kind of needs to do it. But that's 15 to 20% of your stock market, which should take a hit as a result of it.
Yeah.
That doesn't happen in the US, right? Where in the
No.
US, you kind of going, well, the rest of the world markets where you just don't have that concentration, and a single decision like that can't actually impact the market so much.
It's a domestic focus. It's small, sentiment driven. Also, I think the other thing to kind of layer on there, which is probably connected to the sentiment piece, is that when the interest rates change, the change in the interest rates can affect us faster. And one of the reasons why, just thinking about this from a property perspective on your mortgage, you can only fix your mortgage for up to 5 years, whereas in the United States, you can fix it up for up to 30 years. New Zealand's not the only one, though. So in the UK and Australia, Sweden, Canada, I believe, would be another one. You similarly will find that their economies will probably come to a complete stop faster in a high interest rate cycle and maybe rebound faster as well. So I think in this together, I think even like a portfolio that was made up of those economies in this period of time, high risk, but it could bounce back. They grasp for air stronger, right? Because they've been suffocated the most.
Cool. And a little bit like our crypto conversations, right? Small and low liquidity can be a good thing because when sentiment turns positive, it moves pretty quickly, right? And I think that's what we've seen over the last couple of weeks in New Zealand, and we're probably likely to see a bit more of it. The flip side, though, is that a pretty big negative GDP number or slightly higher inflation in the kind of back end of this year could quickly turn all of that around.
Yeah. Okay. Topic of no, we're not on this topic at all, but I'm going to introduce the topic of I can't even say it, oligopoly, right? And
The oligopolies. We've got a few of them in New Zealand at the moment.
We do, and let's pick on the favorite one, right? So the Commerce Commission has look at competition in the banking industry. They have determined that the New Zealand banking scene is indeed an oligopoly. An oligopoly means that they don't necessarily act in collusion, because if they did, that's also known as a cartel, and that's a big no-no. But they move kind of coincidentally in a pattern, and prices are high. So there's big profits and a lot of influence that these banks exert over the New Zealand economy. So the result, or where this actually goes ultimately, kind of like what you were saying with the power situation with the gentailers, there could be more pressure on them to savings through, especially in a falling interest rate environment. What do you think this with this Commerce Commission report? What do you think the outcome is going to be here? Are we going to see more regulation come in? Are you actually going to see that are standing up to the banks? Or are you going to see the same old thing happen where it's like, we're going to leave if you don't allow us to make these supernormal profits?
Oh, the stat that shocked me was when someone said, I think we're 6% of GDP is the bank profits, right? That's just a tax on the economy. But that's a different conversation. But what do I think is going to happen? Absolutely nothing. I think the main ideas that have come out of the Commerce Commission, just to me, they don't hold muster, right? Current capital ratios. Oh, we shouldn't be doing that. Come back to what I just said before about New Zealand being a higher risk economy, and therefore we need to make sure that our banks are appropriately capitalised. We're not asking them to be a higher capital ratio than anywhere else in the world. And actually, even worse, if we want lower capital ratios to enable small banks to prosper, that's just a recipe for disaster, right? That's just going to mean that we're going to have more banks going bust, and it'll be the smaller banks, and that'll end up with the taxpayer on the hook. So personally, I'm not a big fan of lower capital ratios. Second problem we have is second answer around KiwiBank. Look, yeah, they can privatise KiwiBank. They can give it a whole lot more capital. Why would a privatised KiwiBank look to change the market and do things a whole lot differently, right? At the end of the day, they will become, and they are subject to standard business norms and standard business needs. The sad thing is I actually don't think they can privatise KiwiBank. The problem with KiwiBank is that it currently delivers a 7% return on equity versus the big Australian banks, or New Zealand arms, the Australian banks, which are delivering a 14% return on equity. So you can privatise. And sorry, the other bit that KiwiBank's got somewhere, the rumour mill has it somewhere between a $200 and $500 million IT bill over the next little wee while. At the same time, KiwiBank, because they need to grow, they need to preserve capital. So you're asking me to kind of, as a KiwiSaver manager, you're asking me to invest in a small subscale manager with a massive IT bill to deliver significantly lower returns than I can just go if I go and buy one of the existing banks. And so that's a pretty hard sell. So the only way that gets across the line is if that's done at a pretty big discount to book. And I don't think that's politically feasible to do that, to be blunt. So again, I come back to nice idea, great headline, practice, not going to work, right? And then you get to some of the smaller things, right? So the idea of making life easier for financial advisors, creating clarity around what is a good financial advisor from the bank's perspective and a bad one, right? So you've got to remove the threat of removal of accreditation if an advisor doesn't have a high enough conversion rate and they're just price checking. You got to kind of create a whole lot of, there are things like that, which I do actually think hold a whole lot of credence. And so that can be done in the advisor space, that can be done around banking, some of that space, that can also be done around fees. So us sitting there going, you know what, there are a whole series of bank fees that are charged right now. Let's just kind of name them and go, look, if that's the fee, then it has to reflect reasonable costs and it can't just be a profit center. My very strong view is I think we're going to struggle to get competition in that core banking business, which is where we need it. And so therefore we need to treat these guys like monopolies, regulate them like monopolies, and actually limit where and how they can make their money.
So more regulation is what you're saying?
I'm saying far more regulation, yeah.
You also think smaller capital ratios, not a good idea because that would just encourage smaller banks, which increases systemic risk basically, right?
Exactly. And the problem with this, and again, there's two parts to that story, right? You can introduce systemic risk to the system as long as it's small enough. And there is a strong argument which says, hey, if it's really small bank and therefore they're not really a risk to the system, who cares? But then you got to make depositors fully aware that if that bank is small, that bank holds less capital than others, it is higher risk. And if the bank falls over, who's going to pick up the pieces, right? And if you don't have, and this is what we found in 2008, if the small non-bank sector and the smaller banks don't have the deposit guarantees, everyone just rips their money out as quick as they can at the moment things get bad. And so, that's where it gets a little bit perverse, right? You kind of go, you need the deposit guarantees to protect the small guys. And then if you're sitting there saying, but at the same time, we've got lower capital ratios, and it's going to go bad. And the taxpayer, you and me, are going to be the ones that have to clean up the mess. And personally, I don't think that's a great answer.
I kind of feel though that we're like poking the old man's cash cow here when we talk about the banking scene in New Zealand, right? Like it really is a profit center, and it really is, 6% of GDP is phenomenal. What do you think about open banking then as an alternative? Because maybe even just from a fintech perspective, buy little then all at once. Do you think that's got some merit? And do you think that eventually would back away from, to be honest, blocking that from occurring?
So sorry, open banking they have to do, right? That's just absolutely insane that they've been allowed to drag their feet for as long as they have. The government's just got to say, here are the rules, and making it very clear. Here's the timeline, and it needs to be ambitious. Let's make it 6 months or 12 months maximum, and we're going to fine you $1 million a day if you miss that deadline. Guarantee they'll hit it if you do that. So open banking, but I don't think open banking in itself is the whole answer, right? Open banking makes a lot of the ancillary services and a lot of those ancillary products easier. It means current accounts, payment systems, some of that stuff gets a little bit easier, but it doesn't actually address a whole lot of core lending, a whole lot of some of that core stuff that banks actually do, right? So that's kind of one of, my concerns. I'm not 100% convinced that it does do a lot. And the evidence out of Australia is that open banking has not materially changed the competitive landscape. One example where it is actually working and they're doing a bit more, which I don't know why it's not being talked about in New Zealand. I kind of know why, but we shouldn't be letting them. A big idea that's working pretty well in Europe at the moment is bank account portability. So I can have the same current account. The moment I go tomorrow and take out my mortgage and I want to move my current account to someone else, that's one of the big ideas of going, actually, bank account portability is going to be there, right? So to my mind, the suite of measures that I would like to see around kind of increasing in the competitive state. Open banking, like you've talked about, but an accelerated timeline around open banking. I'd like to see bank account portability. And actually, I'd like to see restrictions on on kind of how far and wide banks are allowed to go in their ancillary products, because they do have this massive advantage in terms of distribution, in terms of their kind of power to influence through their lending decisions. And so I go, well, let's acknowledge that they're in an unfair position and let's just shut that shit down.
I agree. Let's do all that. That's good.
But here's my big point, though, is that none of it's hard either. Capital ratios adds risk. Kiwi Bank adds risk. None of that stuff is that hard. There's a whole world of other stuff that can be done, which actually doesn't necessarily go too far wrong, right? And doesn't take too long. And I think the problem is we focus on the big headline solutions, the stuff that's kind of the politicians can talk about, but actually it's in a lot of those little nitty gritty things that we do that are going to make quite a big difference in my mind.
I agree. Meanwhile, like there's another parallel dimension I know outside of the discussion around crypto as just an asset class. We've never really sort of gone much deeper beyond that into the ecosystem in which that lives. But decentralized finance, meanwhile, I got a pretty good eye on that. And from what I can see, there's a lot of development is picking up serious pace.
Yeah.
So I'm not going to suggest that that is going to take over and replace everybody's jobs in the traditional finance world right away. Absolutely, like the stronger the blockage is right here, people are demanding something better, and that something better is actually being built side of the current system, which locks out internal competitors from rising up. So it's a very fascinating thing to watch this play out. But I'd say, hey, like in another 4 or 5 years, look back at this point in time and just marvel at how old-fashioned banking used to work in New Zealand. Like you can see a big change will come inevitably at some stage.
I hope so. It's just the big piece that I can't quite get my head around. It's the size and scale of those balance sheets and what that does for their cost of funding. And I think that's the bit that maybe decentralized finance helps that because it makes it easier to match borrowers and lenders together. But it's a hard one, right? That's the bit that I'm struggling with.
Okay. No, but there's plenty of stuff going on, and I think like this conversation around the banking scene that's probably one of the big things that's to play a big feature, especially in a falling interest rate environment. And so in New Zealand in particular, I think that's going to be topical for a while. Although, like we've got everything happening in the United States in terms of what's happening with their hopeful interest rate reduction, and then throw just for good measure a whole bunch of geopolitical stuff, which is continually happening. You know, we have a tanker ship that is 4 times the size of Exxon Valdez, which is currently on fire next to the Houthis.
Right.
Haven't really read. I only just stumbled across that on X. Thought it was true and then moved on. But I was thinking about that coming into work today. Like that's quite phenomenal. Like we have an ecological disaster that's unfolding, as well as potential World War III in the Middle East breaking out, as well as incursions into Russia by who knows who. Fantastic times to be alive, right, Rupert?
A very, very, very interesting time, right? And I guess it really is a signal of the times that there is so much shit happening around the world, right? Where we're going, it's fine.
It's part of it. It's just part of it. Just bring on the cowbell, bring on more, quantitative easing and lower interest rates, more credit. It'll solve everything, and we'll go another round. Times.
Nice.
Well, thank you for the conversation. Next week, it'll be just like this, but more. So I'm looking forward to that conversation.
Okay, well, thank you, and I'll speak to you soon. Speak to you next week. Thank you.
See ya.
Bye.